What you're seeing here is this is a screenshot from the SEC website, and I think many of you are familiar with it. And we're starting to see a much greater regulatory review of companies' XBRL formatted financial statements. This clip from the SEC website points to a sample letter that the SEC began sending to CFOs of certain companies just last month. And in this letter, they're expressing concern about companies not adhering to certain XBRL requirements that are related to calculation relationships. We also know that more and more investors are reviewing and they're actively using the XBRL data that you're submitting. They're not just going to your website to pull the data, but we know that they're using data from data aggregators who are extracting and databasing the content and then serving it up to their clients. This next chart that I'm showing you here takes a look at content in a database that we've created. We database all the filings, the XBRL filings that you submit to the SEC each month, and we do a thorough review of all of the data to check on the quality of the underlying data. We check the data for potential problems related to the use of the US GAAP taxonomy. These are problems like picking an incorrect element or using an element inappropriately. This chart gives you a picture of what we have been seeing. And the chart, as you can see, indicates that errors by respective quarter are increasing slightly. And we're seeing that the error rate for the 10K filings is actually increasing at a much faster rate. If you look at Q1 of 2014, which had aggregate errors of 254,000, you can see that that's significantly higher than the previous year ago period. The errors that we see reported in the most recent period, in all the charts that I'm going to show you going forward, may not include every filing, because basically I pulled this data yesterday, and it just shows the filings that are submitted as of the time that the report was pulled. So all of the filings may not have come in, so therefore all of the data is not available. So data for the most recent period may appear lower than it really is. So that gives you a picture of the errors overall, and you can see, as I said, that they are increasing. This next chart looks specifically at negative input errors. And we've all heard a lot about negative value errors. This graph shows the sum of negative value errors reported when a positive value would have been expected. This situation occurs when a value is entered with a negative value, but the taxonomy is structured and the element is defined in such a way that it should have been positive. The good news we're seeing is that these types of issues have been declining over the past 2 years. This has been a big issue for the SEC and for many filers over the life of the program. And we know that filers have taken note and they have been trying to address this issue. However, we do see that in the most recent quarter, we're still seeing 34,000 negative input errors, so we still have a long way to go. So remember I told you that overall we're seeing there's been an increase in errors. So where are those errors going to? If we're not seeing as many negative input errors, where are the errors coming from? This graph shows the sum of errors that occurred when members were used on an axis that was inconsistent with the modeling defined in the US GAAP taxonomy. So for this particular issue, and Greg is going to explain a lot further about these individual types of errors and basically how they occur, but for this type of issue, error rates have increased substantially since the beginning of the program. And we see that because the use of dimensions has increased. So invalid axis member combination is a continuing problem, and it's getting bigger. So this shows us that the use of dimensions is a problem for filers. And this really should be an area of focus for companies making corrections in their filings. Okay, now this chart gives a snapshot of all of the different potential types of errors. So we've identified over 30 categories of potential problems in filings. And this pie chart groups them and shows the relative frequency of each kind of problem. So as you can see here, the most common one today still is that invalid access member combination. So a lot of people think that it's negative values, but it's really the dimension issue. The second most common problem, as you see here at 17.5%, is again the non-negative input error. So that continues to be an issue for companies and filers as they grapple with how to manage this. The third most common problem are required values that are not being used, that are absent from filing, and that comprises close to 14% of all the errors that we see. And the next most common error at about 12.4% are dates and context used incorrectly. So you can see just from this pie chart that there's a lot of different potential issues for companies as they create their XBRL filings. So a lot of pitfalls in working with the XBRL data. Okay, this next chart takes a look at errors as a % of facts reported, and it looks at it on an industry basis. It's a little bit hard to read because there's a lot of data on this screen, but it gives you a picture of which industries are faring better than other industries. Financial services has an historical error rate of about 2.65 errors for every 100 facts reported, and that's in the most recent quarter. Mining, however, fares much, much worse, with higher errors for every 100 facts reported in the prior 2.5 years. So you can see that if you look at the purple bars on this chart, the two kind of light blue bars that you see that appear to have the most errors actually represent companies that are not in a specific industry definition, so we're not going to focus on those too much. And again, as you look at the most recent quarter, this is only showing a percentage of all companies filed, so the bars look relatively low compared to other bars. But this just gives you a picture for which industries are having a more difficult time than other industries. This next chart takes a look at the same information, but it looks at it by company size. So it shows the error rate by company size as a percentage of facts reported. The company size is based on the SEC filer category. And the chart that you see here shows that the average error rate is higher for small companies. And you see that in the purple bar. And it's not so surprising. I mean, smaller companies have had less time to become skilled in XBRL reporting. Small companies were phased in last. So the larger companies have had a lot more experience. So you're probably wondering, where does all this data come from? And you're probably thinking, gee, this really shows that data quality continues to be an issue in SEC filings. The errors that that I've reported on in these graphs can be viewed as what we're calling consistency errors. These represent situations where a filer created data that does not adhere to the concept definitions or to the structure of the US GAAP taxonomy. There very likely may be other errors in XBRL filings that are a result of things like incompleteness, inaccurate inputting of data. And for those kinds of errors, a manual review by the filer themselves, with help from their auditors and their service provider, can really help to catch other kinds of problems in XBRL filings. But the errors related to consistency that we've been showing you here today are problems that can be easily resolved. We strongly encourage filers to perform the kind of checking to identify and fix these problems. What you see in front of you right here is a set of tools that we've created called the data quality tools. And we've created them to help filers in this process. This screenshot shows the home page of these tools. On this home page, you can see if you look in the left-hand navigation bar, you can find analytics that identify trends and errors, such as the graphs that I showed you earlier, and it goes much deeper than the ones that I've shown you today. There are also resources, such as guidance from FASB, from XBRL US, from the SEC, and there are even some company-specific tools that you can use with your own filing. These are all freely available to filers. This next page that I want to show you is also within this tool set. And this is a tool that we call Check Before Filing. And this allows a filer to upload their own XBRL document as a zip drive to check to see if there are any errors. This is the kind of report that's generated when you run this tool. It'll show you if you have any errors, and it'll show you what type of error you have. If it's a negative value error, if it's an invalid access member combination. It'll also show you what type of concept it is that's at issue. Is it a cash flow concept, an income statement concept? Once you've run the summary report, if you do have errors, and if you're interested in finding out more about those errors, we'll be happy to send you a detailed report on how to fix the errors, and we'll give you a walkthrough of the report to explain how to resolve them. The last thing I wanted to mention before I turn this over to Greg, who's going to go much deeper into these kinds of errors and what they mean, is I want to mention a training program that we have coming up in Bellevue, Washington this year. This is our XBRL US National Conference, Current Developments in Financial Reporting. It takes place September 15th through 17th. And this is a really good opportunity to help you get the training you need so that you can resolve the kinds of issues that I've just talked about. During the program, during the 2.5-day conference, we'll be providing updates on new ASUs. We'll talk about some of the significant changes in the taxonomy that you'll have to deal with in the pensions and the fair value disclosures. We'll be providing intensive hands-on training, and we'll do that in a workshop format because we feel that that's the best way to really get the most out of it and to walk away with tools that you can use immediately. We're also going to have panels on how XBRL is used by regulators, standard setters, investors, and some of your own peers. We'll also have panels on XBRL. And tomorrow, when we email you the link to the replay, we'll also send you a special offer to webinar registrants for that conference. So with that, I'm going to turn it over to Greg, who's going to take you through some more specifics on the data quality issues and what needs to be resolved and how to do so. Greg?
Thank you, Michelle, and thank you to everybody who's participating today. So on the screen, you can see our objectives. We're just going to quickly walk through and talk about from a slightly different perspective that which Michelle already addressed. And we'll talk about specific data quality issues, different validation methods, automating versus manual validation. And I would suggest to you that XBRL being an automated form of financial reporting, that many of the checks, just like with your accounting system, should be able to be automated. And then what can be done in order to improve the quality of your data. In other words, the footing and proofing of your XBRL financial information prior to issuance. Again, this is the slide that Michelle had shown before. This is a summary of different inconsistencies, data quality issues that have been identified by XBRL US based on a validation set that we've created, starting back with the publishing of the 2008 taxonomy, really shortly thereafter. And you can see that there's over
Greg,
30
if I could just interrupt, we've gotten a couple of comments.
Yes.
Greg, I apologize to interrupt it, but we've gotten a couple of comments that it's a little bit hard to hear you. So if you could just get a little bit closer to your microphone, that would be great.
How possible that will be, given that I'm on a handset, but I will certainly try to speak more loudly. So if you take a look at the data quality issues, you can see that there are 30 categories of logic that are being checked, over 30 categories. Again, much of the checks that you need to do can be automatically programmed. Things that address data selection, individual facts and how they're defined in the instance, the combination of elements such as access and members that you have defined in your taxonomy and related through your link bases, etc., can be programmed and can be automatically verified for you, just like using a calculator to put your financials. So just talking about recent trends, as Michelle was doing, And I apologize, but one of the headers is missing. But you can see here that on the graph, what we're looking at is the phases of filers as they came into the program. So phase 1 was large accelerated filers over 5 billion. Phase 2 were all other large accelerated filers. And phase 3 was everybody else. And if you take a look at it, you can see that the proportionate share of filings or data quality issues to the number of filings is fairly consistent and as expected. And some of that has to do with learning curve, but again, many of the large accelerated filers and many of the accelerated filers that are in that phase 3 group, they actually also have sophisticated financial statements, so they have more complex tagging issues, and that also leads to higher error rates as well, and we'll talk about that in a minute. Going to the next slide, if we take a look at the graph, you can see that this is giving us the total number of issues by year across the entire public database, so all filers, the total number of filings, and the average number of issues per filing. And you could see that the average number of issue filing actually increased in 2013 and 2014 not being annualized. And really the contributing factors there are sophisticated changes in the taxonomy. The U.S. GAAP taxonomy is authorized by the SEC, published by the FASB. And there's many changes there that actually affect the format, the taxonomy that you had as your extension taxonomy already established. And if you were not aware of those changes and it was not automatically built into your instance creation softwares, those became data quality issues for your filings. And again, just taking a look at it in another perspective, data quality issues phase by year, you can see that again, it runs fairly proportionately. So it's not as if one group is doing significantly better than other groups. It's that the types of data quality issues that are arising, though, the actual detailed data quality issues vary. So you'll see that the more recent groups to be filing, so the phase 3 companies, are still making some very rudimentary errors that the phase 1 and 2 companies are not, but the phase 1 and 2 companies are dealing with much more complex tagging and therefore need additional assistance and/or automated checks to be able to validate their data prior to issuance. And again, now you can just take a look at the number of filings by phase by year, and you can see again it's as expected. And just so that you understand, there was about 550 companies in the first phase, approximately 1,200 companies in the second phase, and then that third phase group was over 8,300 companies. So you have approximately 10,100 or so companies filing to date, or in that database. And again, when you take a look at the average number of data quality issues per filing, by phase per year, if you just take a look across the years, you'll see that it is fairly consistent. And again, the issue with phase 1 is that they're dealing with much more dimensionalized footnote disclosures that they have with axes and dimensions, which are a little bit more complex than rudimentary phase financial statement information or values that are reported in default. But you can see that it does run fairly consistently across. So it's more the quality of the issues that are arising from a data quality perspective as opposed to one group of filers being so much farther ahead than others. We're still all progressing along that same learning curve. And then I know the SEC had observations recently on extensions, and if you take a look at the extensions by industry, over time, you could see, and this is against the entire public database to date, you could see that overall there's an approximately an 18% extension rate, but it all depends on how you really defined extensions. Extensions can be defined by concepts reported, and therefore you count anything in a company's own namespace against all concepts reported by the company in their extension taxonomy and used in their instance, or it can be counted by the number of extended facts. So for instance, this is based on primary concepts only. Primary concepts are line items or financial tags that actually tag the data. And the reason why we did that is because a lot of the dimensions, the axes in the base taxonomy expect extended members. And that will artificially increase the extension rate, even though that extension rate is expected. So by looking at only the primary concepts, what we see is that there's about an 18% extension rate overall, probably a little bit higher than we'd like, although we'll never get to zero because the base taxonomy will never have every financial reporting concept ever needed. Also, what contributes to this is you could see that by industry, some industries are underserved by the authorized taxonomy. Again, things are as expected, and I don't think there's any true anomalies that are showing up here. With that being said, let's talk about some of these more common issues. So invalid member access combination is the highest or most prevalent issue that arises. Now, when you think about an axis in the base taxonomy, or what I also refer to as a dimension, those are synonymous, they are synonyms. So dimension or an axis is a common theme about which you provide more information. If you are disaggregating a concept such as sales or cost of sales across a common theme, the adjectives and nouns, features and characteristics that provide that detailed further information on the fact value that you are defining have to be generic to, in line with that common theme. So obviously you can see here we're breaking things down by geography. Fair value is not a geography. A fair value member would not be expected and should not be placed on a geography axis. Same thing with the legal entity axis. You do not put segments on a legal entity axis unless that segment is indeed a legal entity. So you would never expect to see any kind of accrued expense member on a legal entity axis. Members that you put on an axis have to belong to that common theme. So if you take a look at this debt footnote, the debt instrument axis in the base taxonomy, which is available in the 460,000 group, if you take a look at that debt instrument axis, the domain is actually specific as to what is expected for the members to be included on that axis. The domain is the collection of all the members for that axis. And just by the way, domains should not be moved or placed onto other axes in the taxonomy, and you should not replace a domain that's modeled on a base taxonomy axis. But the domain for the debt instrument axis says that it is the collection of specific debt instruments of the company. Well, every company's debt instruments are individual and unique to them. Therefore, that domain is open, it has no members, and it expects you to create extensions. Senior subordinated notes, the one that has the X through it, that is a base taxonomy member, and it belongs on the long-term debt by type axis. That member represents the generic total of all senior subordinated notes. It does not represent any specific issuance of a senior subordinated note. Therefore, it should never be on an axis that always expects a specific debt instrument. So again, invalid axis member combination, it's just a learning curve. It's not all that difficult, but you just need to be aware, what does the member represent compared to what the purpose of the axis is, the concept or the concept about which we're providing more information. Excuse me. Another high prevalent issue, and this is definitely affecting more the newer filers in the third phase than those in the first two phases, are negative values. Truly, about 90% of all elements in the taxonomy expect a positive, absolute, not debit, not debit, but absolute positive input. The reason being is that it's just like your accounting systems or a T account. Debit credit values for monetary items, or the definition of, for instance, the percentage of tax credits can never be negative, because then they're not tax credits, they would be tax expense. So again, most, if not all, 90% plus of all concepts expect an absolute input. If it's not reasonable or likely to have a negative value, then you certainly should never have such. Again, it's the logical data input that would exist, not unlike an accounting system. So when you take a look at what elements can accept negative inputs, here's a listing of such elements. And they are, well, I refer to them as two-way elements. The positive input would be the input that would be generic or natural for the modeled balance element. So if you have a cash flow increase-decrease, and it's the increase-decrease in an asset account, and it's a credit balance type, the increase in that asset would be a positive input. If the asset decreased in the cash flow movement, that would be the negative input. So again, it's really just a logical understanding and an application of your accounting and financial reporting experience. Again, negative value, just basic accounting knowledge. You know that you have a concept that's interest expense. It's defined as the expense charged against earnings for the period. You know it's a debit, and you expect it to be a debit. It's a positive input. It's never, the negative would be interest income or an adjustment to interest expense or a reversal of some sort. Not the same concept. So again, pay attention to the definition. Don't read more into the definition than is there. And just use your financial reporting common sense and your experience in order to help you input the right value. Again, negative input, accounting relationships. So here we're looking at stockholders' equity, which is our beginning balance. And that's right here. Okay, so that's our instant. And we're breaking it down by the components of equity. And here we see treasury stock. So the element for the beginning balance, controlling interest, stockholders' equity, including portion attributable to non-controlling interest, credit balance type. Treasury stock is a natural debit, a negative or a reduction, a contra equity account. Therefore, the input, the value intersecting with the treasury stock member representing the treasury stock component of the overall stockholders' equity for the period, the opening balance, is a negative value. Why? Because the primary concept, stockholders' equity, portion attributable to non-controlling interest, is a credit. But treasury stock is a debit, so it's a negative credit. We need a negative value in order to represent that value effect. So the general rule of thumb is really just think about your accounting system. For all monetary item types, there are debit and credit values, 90+% of all those concepts, absolute debit, absolute credit. Okay, the values are neither positive or negative. If you have a two-way element, the positive input will be generic to the balance type, the natural balance type. Income items, if it's a credit, and it goes both ways, like net income loss, you have your income is going to be a positive input. If you have a loss, it's a negative input. But for all the other elements, 90+% of all the other concepts, it's a single value that's expected, a debit or credit. Okay, don't think about how you present it, and that's where a lot of entities run into problems, and that's because they are tagging with a tool that drops a tag onto their HTML. They show a number in parentheses, and the program automatically interprets it as a negative value. It's not a negative value. You need to manually override that. Some of the tools are actually putting out non-negative checks for you to help you find those values more efficiently and more consistently so that you don't have to do it wholly manually and by human intervention. Also, read the definitions and don't read more into them than's there. Okay, so even though you might have a tax benefit or expense line in your statement, if the element you're selecting is only tax benefit, it can't be an expense. It can only be a benefit. Again, make sure you understand what the concept is, because the EFM, as we know, says that if everything about the element is correct and the balance type's not what you expect, invert the value, put in a negative value. That's very true. However, the definition of that element has to be everything that you expect. And if it says this is a tax benefit and that's it, it cannot be an expense. Okay, required values not reported is another issue that comes up quite often. So what we're looking at here is from 6.520 and 21 in the Edgar Filing Manual. And this is those elements that the SEC expects and is required by certain form types that you file. But you can logically set up the same kind of relationship for other things that are required. So as we would expect every company to use assets that's modeled in the base taxonomy. Why? Because everybody has assets. So at a minimum, we would expect that everybody would have that element. If we don't see that element, we would tell you that you're missing a required element. So again, these are required by the SEC. These are the only elements that they're focused on specifically. And the rest of the Edgar Filing Manual is very structural in nature. However, know that you can program for other things that are expected. You had net income loss, you had a public float, we expect we're going to have earnings per share. So again, there are things that you can logically program to check for and validate that the information that you're reporting in electronic form makes sense and agrees with your expectation and your intentions. Talking about earnings per share, here's an example of just that. Here the company has income loss from discontinued operations net of tax. However, in the instance, we're not seeing any earnings per share reported. Well, we know that if you report discontinued operations, that in your footnotes at a minimum, or most likely on the face of your financials, you will report the earnings per share from discontinued ops. If we don't see that tagged at all, we report an error and we bring it to your attention. Now, maybe you've extended for that element, or maybe you've selected some other element that's not a per share item type. I don't know. But the fact is that there are a finite number of earnings per share from discontinued operations in the taxonomy. So it's something that is easily modeled and programmed. Inversely, to a required concept is when you have a non-valid intersection. So when you have a dimension, you have an axis, it's a common theme about which you provide more information. The members are the details of that common theme that you are applying to further define, provide context on the fact values, tag items that can't ever intersect with certain members. Net income can never intersect with common stock. It's just not possible from a financial reporting standpoint in accordance with US GAAP. It just can't happen. So we know that there are certain of these relationships. Now, some people, if they like to be very fancy, will call things negative hypercubes, which are not allowed intersections. But because of the way the US GAAP taxonomy is modeled, we can't provide that electronically in the base taxonomy. However, you can program rules to do that. So again, concepts should be empty for certain illogical and non-appropriate dimensional qualifications, net income to additional paid in capital, etc. Calculation anomalies. Now, the SEC is very focused on missing calculations, and I don't believe they fully automated that yet and made it part of their test suite. However, I know that they've been working on it for some time. Now, we do have rules that look for missing calcs based on those elements, those concepts where we always expect the calculation relationship, somewhat like assets, stockholders' equity, and liabilities. Not total liabilities, though, because a lot of companies will report in a classified presentation the total of current liabilities, then have all their non-current liabilities and roll straight into or directly into their equity section. So they don't ever actually have an interim total of all liabilities. But stockholders' equity and liabilities, that is a total where we would expect that concept to be in a calculation relationship. So you can write rules for certain elements, missing calculations. In addition to that, there are other calculation anomalies. So you can develop roll forward calculations. Does the instant beginning balance plus the movements for the period equal the closing instant balance? Now we know beginning and ending balance is the same concept. So based on the presentation, you pick up the appropriate position and value in the instance based on a period start label and period end label, and then you take all the elements that are between them and you compute a roll forward. So you do it based on a formula that's not available in XBRL as a global standard. Also, data calculating across members on a dimension. Most or not many of the durational item types and instants in taxonomy are accretive. They can never be reversed during a period, so that the aggregate total over time, the longer duration value, should always be greater than the shorter duration. In other words, the year for revenue should be greater than the quarterly revenue. If you see an anomaly where the longer duration value is less, that raises a red flag. So that's something that can be programmed. Per share calculations also can be programmed in order to have validations for them because they're just simple calculations. However, some calculations are very complex, like two-class method, and those take a great deal of time and effort in order to program rules for. But again, you want to make sure that your information is logical based on what it is you're trying to report and the tags that you selected to communicate that data. So the SEC has been working very hard on missing calculation relationships. Generally speaking, I would approach it from a best practice standpoint because the EFM does say wherever you have in the HTML 2 or more line items that come to a net or a total during the required context period. So the required context period only speaks to the date of those financials, not to any dimensional qualification. Okay, you must provide an effective calculation in the DTS, that's your extension taxonomy, if there are values associated to those elements in the ultimate exhibit, in the instance. Bottom line is, personally, I would provide calculations wherever it's logical to provide them, as opposed to trying to interpret that rule and only provide calculations where the SEC is mandating it based on how I interpret the rule. I would just be more logical about it. For instance, we have a lot of companies that are not providing calculations for their balance sheet if they have a class of stock axis and multiple classes of stock. Bottom line is, you should because the concepts and the calculation relationship are in the extension taxonomy and have nothing to do with the values in the instance. It is presented in the HTML financials and it's implied, and therefore just because it's now being dimensionally qualified, certain of those facts, i.e. the classes of stock values on the balance sheet in XBRL, would not necessarily alleviate the need or the requirement to provide an effective relation. So again, logically, if a calculation is applicable, I would provide it. Again, your interpretation of the Edgar Filing Manual is your personal interpretation or that of your service provider. But again, for me, if it's logical, I'm going to do it.
Greg, let me jump in here and ask a couple of questions.
Yep. Sure.
Okay, and we've actually gotten a couple of comments from people just noting that missing calc errors are very serious errors that make the entire filing invalid. But one question we did get is please advise what extension rate should be used for I'm sorry, what extension rate for primary concept should be a benchmark?
I would suggest to you that there is no benchmark, that if you need to extend the taxonomy because you have a unique aggregation or you have industry-specific financial reporting concept not provided by the base taxonomy, or because you're providing more specificity than provided by the base taxonomy, that's an appropriate reason to extend. The U.S. GAAP taxonomy is extensible for a reason, and the fact is that the U.S. GAAP taxonomy, as authorized, will never have every possible financial reporting concept available to you. So again, I would use common sense, and I would make sure that when I search for an element, my premise, the way I always go into it, is that it exists. When I look at the U.S. GAAP taxonomy, I always assume I'm going to find what I need, and after a diligent search, whatever that is and how you define it, for me, it can be a very considerable amount of time, which you may not have available personally in your other responsibilities. But after a diligent search, if you don't find it, then it's appropriate to extend. Now, but again, you always want to approach it with the thought that the element you need exists in taxonomy. But it's not a degree of percentage of extension, because again, there's always going to be extensions, and I don't know what the ultimate correct percentage will be, because over time it should reduce, but I don't think it's ever going to be zero. Michelle?
Great, thank you. Yes, that's it in terms of questions for now. If you want to continue. Oh, wait, let's see.
All right. Yeah.
No, go ahead, I'm sorry.
I will. I'll just pick up. But with regards to the comment, missing calculations is significant, and it is a significant issue. And I don't know that I said anything to minimize that. But mind missing is really more of a manual check. You can program for certain key assertions that you always expect to be related in a calculation relationship. But I don't think that you could do it across everything, because there's just no way to know. I mean, some companies might have a calculation of working capital in their published financial statements, and another company might just disclose working capital as a debt covenant. So there's in certain respects, there's no way to know whether or not a calculation is required or not. You need to know the H&L financial statements personally. But it is a very certain comply with the Edgar Filing Manual, which is the purpose of the SEC in their recent activities and efforts. So subsequent dates. This is really just accounting common sense. So if something is as of, it's a contractual obligation to the company. It's something that exists as of the reporting date. It's going to get the required context. If something is an event or transaction that occurred subsequent to the reporting date prior to issuance of those financials, or when those financial statements are ready for issuance, it's going to receive a subsequent event date. And by convention, agreement with me, it will also get a subsequent event member on the subsequent event axis. If the value that you're reporting is getting a date context that goes out more than 90 days past the end of the reporting period, the balance sheet, then that's a forecast, because otherwise we would expect that it would just be reported as a current event in the next set of financials. So if you're reporting something that goes out with the context more than 90 days past year end or period end, that should be a forecast. So again, it's really just common sense. It's just accounting and financial reporting experience. There's nothing unique about it. Know the values that you're reporting, understand the concepts that are in the paper and the published financial statements, the HTML financial statements, and then carry that through to the XBRL. Calculation weight. David, I don't know what happened here, but it does appear to be blank. Is everybody seeing that same screen?
It is blank, Greg, yes.
Okay. Well, I apologize for that. If you are purchasing the slides for further reference, it won't be blank. Just know that the calculation relationships and the calculation weights depend on the relationship of the balance type of the parent element, so that would be the summation parent, to the summation child. Debit child +1 calculation weight. Debit parent, credit child -1 calculation weight. Same thing for a credit parent inversely. Credit parent, credit child +1 calculation weight. Credit parent, debit child -1 calculation weight. Calculation weights are not formula based. What they are communicating is the impact of the value to the summation. So a value with a -1 calculation weight has a negative impact on the summation, but there is no formula. It's not like Excel where the cells add up to a total. So again, it's just communicating that this concept in reference to that concept has a negative impact. Here you could see the logical basis of it. So here we have a line item, net cash provided by used in operating activities. It actually has no balance type based taxonomy because net income, which is credit balance type, is accretive to the debit adjustments to get to net cash provided by used in operating activities. So because of that, the balance type was taken off of the element so that we could escape or not be affected by the calculation weight rules that I just spoke to you about. So net cash provided by used in operating activities, no calculation weight, but a gain loss on sales of loans net has a credit balance type. So we know a credit going at reconciliation to get to net cash provided by used in operating activities is going to have a negative weight. We know that debits are going to have a positive weight because credits represent cash outflows and debits represent cash inflows. Logical basis. It's just financial reporting and accounting rules that apply here. It's just logic. Okay, deprecated concepts are often being used. At this point in time, most, if not all, the instance creation tools of which I'm aware in the market have check find deprecated items. The consistency suite that we spoke about earlier, the consistency checks also. But deprecated concepts are deprecated and not eliminated from the taxonomy so that they don't break prior instances that used that taxonomy that's still authorized. They're left in the taxonomy for a period of time. I believe the FASB is giving the deprecated concepts, I believe it's something like 5 years before they actually remove them so you won't see them in the taxonomy, but they still exist out in space. So again, deprecation is really a programming concept or a word. It just means that the piece of program is no longer being used, no longer supported, and it should not be used any further. But don't remove it because it might break other programs that we are using. And that's all it means. So if you see a deprecated concept or if a concept you used in the past has been deprecated, you'll know it by a deprecated label on it. Do not use it. Figure out what the replacement is. The deprecated label, if there is a replacement, should suggest one to you. Make sure that you manually review it and you come to a definitive conclusion that it's the proper element for you before you adopt it. Again, David, I'm looking at a blank screen. I'm really sorry. I don't know what happened there. What this screen would have shown you is the equity section of a sheet. And it would have been circling retained earnings, treasury stock at cost, and outstanding shares. So these are reported in default, no dimensional qualification, tagged directly with a line item on your balance sheet. However, when you get to your statement of changes in shareholders' equity, where I have another blank screen and I will describe this to you, the statement of changes in shareholders' equity is a dimensional table in the U.S. GAAP taxonomy. Therefore, you're going to be using an axis, statement equity component axis at a minimum, and members intersecting with line items that aren't necessarily represented on your balance sheet in order to represent the same values. We refer to these as dimensional equivalents. So for instance, on your on your balance sheet, you had shares outstanding with a value of 451. In your statement of change in shareholders' equity, you're going to have common outstanding member and a line item, stockholders' equity, including portion attributable to non-controlling interest, intersecting with that member on the equity component axis with the value of 451. Those two values have to be the same because the combination of elements in the dimensional structure represent the same concept that you used on your balance sheet in default by itself, the financial tag. So you need to be aware of that. And we see a lot of issues all the time where companies are not aligning the information when the tags really represent the same thing. If we go to our next slide, we should actually see a real example of that. So share-based compensation and allocated share-based compensation expense. When you look at these elements and their attributes and their definition, they are in substance the same exact concept. Now, allocated share-based comp expense back in 2009 was actually only for G&A. However, in 2011, the FASB broadened its definition and they made it so that it actually is a duplication of share-based compensation expense, which appears on the cash flow in the base taxonomy. But when you look at these definitions, these are duplicates. The values in the same context tagged with these two different elements within the same instance have to agree. They have to be equal. There are concepts, therefore the values would be expected to be equal. If those values are different, that's an anomaly. That's a data quality issue. Components, not speaking about missing calcs, but inappropriate calculation components. A lot of times we see companies that reverse calculation relationships of elements in the base taxonomy, which in essence redefines what those concepts represent in substance. So on the left-hand side, you see assets current as a calculation parent to prepaid expense current and non-current assets. On the right-hand side, you see assets current, and it's the summation parent to prepaid expense current. The reason why the left-hand side is inappropriate is because prepaid expenses, current and non-current, represents the total of current and non-current prepaid expense. It is not just the current portion. Therefore, it should never be a child to assets current. It can only be a child to assets. Right. Another thing that we see is calculation inconsistencies is that because people are getting validation summation warnings, and a validation warning is not a bad thing or not, okay? An effective calculation doesn't mean that the calculation on validation will be consistent or inconsistent. You have to read those messages very carefully to make that determination. But it's been our experience that a lot of entities, when they see any validation warning, they correct it, even if it means overriding the data so that it doesn't agree to the HTML. So if you reported what we're looking at, in other words, on your paper financials, you had earnings per share basically $1.30, and it broke down between continuing and discontinued operations of $1.28, and you showed it as 0.01 for discontinued, 1 cent per share. You need to report that exactly the same way in your your XBRL. Do not make it foot. Do not artificially make it foot in XBRL if the HTML financial statements do not do that. Again, you're not allowed to do that. You're not supposed to do that, and it would be non-compliant with the SEC's EDGAR filing manual and the rule on interactive data. Again, missing calculations, don't complete them. A lot of times that's just due to what is referred to as bleeding or bleed through. It's not a big deal. It's the fact is that the revenues were reported for 2009 and 2010, but costs and expenses were not. If that's the case, you tag what you reported. You do not artificially insert information into the XBRL that did not exist in the HTML. If you do, it's a data quality issue and it's a mistake. Okay. Cash flow represented as accruals is another problem we see. Again, if everything about the element is correct, you can use it anywhere it's applicable. However, the cash flow elements and the accrual-based income statement elements, especially when you get down into financing and investment, never coincide. They're different bases of accounting. They cannot be used interchangeably. Now, the income statement items could be in the reconciliation of net cash loss from operations, but it's never going to be used down in financing investing activities. And even in the operational reconciliation, so cash flows from operations, you need to be very careful because not all of those elements are expected or should flow through or can flow through. And you need to make sure that it's correctly a cash flow element that's been provided for you that meets the same need that you're trying to tag. Always an issue. Decimals represent the degree of accuracy of the value that you're reporting. It is a bit different than scale. Scale is a presentational concept for your financial statements. Balance sheet in millions, income statement in thousands. Decimals represents the precision of the fact value. That means that on consumption, I can assume my best case, my worst case, and my most likely case being the value you reported. Because 124 reported with -6 decimals, right, really meaning as in XBRL 124 million means it's accurate to the million, that really could be 500,000 higher or lower. It's very similar to the rounding function in Excel. That's usually how I communicate it and refer to it when I am instructing people in more detail about decimals. But please be aware and just be focused on getting your decimals correct. Every fact value in your instance has decimals associated to it if it is numeric. Okay, so when you're validating XBRL financials, you want to automate as much as you can, but you also have many things that can only be done manually. So the extension taxonomy and the instance document have to be validated. XBRL consists of those two components, the taxonomy, which is the format, and the instance, which is the bag of facts, the completed format. And you really want to validate throughout your process, validate early and often, because I can tell you that even if you can correct the messages you get when you validate at the very end, if you see 600 messages, even if they're easily corrected, it's overwhelming. I've been there, I've done it, it's not a good feeling. You just feel sick to your stomach. So please, validate early, validate often, and automate as much of it as you can, just like you do with your accounting systems. Different types of validation that exist are XBRL validation, that's global specification validation, and SEC automatable components of the Edgar Filer manual validation. Those two validations are very structural in nature. Okay, other than the 13 or so handful of elements that the SEC requires, it's all about the structure of your instance. Does it agree with the global spec? Does it agree with the restrictions on the global spec that the SEC has mandated for purposes of the Edgar system? Okay, but you can also do other validations automatically. So US GAAP taxonomy validation, such as with the consistency checks of the consistency suite published by XBRL US, unit validation, and then ultimately there are going to be certain things such as laid out in the principles and objectives by the AICPA that are manual. So again, it's all these types of validations together create a robust review environment. Okay, the specification validation was referring to the XBRL International website. And again, I'm sorry for the blank slide. I do not know what occurred, but it won't be in the printed slides if you choose to purchase them. Okay, the Edgar filing manual, obviously everyone's aware of it. Version 27 website, they do periodically update it, probably about twice a year, you know, at a minimum once a year. So please be aware that it's there and know that you can find it easily. You go to the SEC website, there's a link for XBRL filers, and then all the information is there. The unit validation is also something that you can automate. The UTR is a International Units Registry. It's up on the XBRL International website. It is an XML file, and it tells you the unit that is expected for given data types of concepts. This sheet is out of the XBRL US best practices, and it's really just a walkthrough or a link in order to understand the data type and how it relates to the unit based on the International Units Registry, the UTR. Okay, I know that over time. There's only a couple other slides left. US GAAP taxonomy validation, Michelle spoke to it in detail, so I'm not going to belabor it. However, the consistency checks are as rudimentary as footing and proofing your financials in XBRL format, or at least that's how I think of it. Okay, just know the difference between automated and manual checks. Again, automate as much as you can to make the process as consistent, comprehensive, and as proficient as you possibly can. It's all about efficiency. So if there's a cost-effective tool available, use it. The manual review, you have to have your processes in place, but again, it is manual. There are things that just cannot be automated. Okay, this is just the logic set, and we've already gone through that. It's there for your review. And please just remember that it's your responsibility as a filer, as a financial statement issuer, to have in place disclosure controls and procedures and to get your data right. The SEC will accept a printed set of financials in HTML, PDF, or ASCII2 format that doesn't foot, doesn't proof, doesn't tick, and doesn't tie. And they may never identify it. If an investor calls them, they'll find it, or if they just randomly select it for review, they will. But otherwise, it's there, and they'll accept it. It's your responsibility to get those financial statements correct. So please put in place the processes to allow you to do that so that the quality of your data meets the expectation and intention that you have when you issue it. With that, Michelle, I'm going to turn it back over to you and thank everybody. If there are any other questions, we'll take care of those individually and we'll follow up with the group as it applies. Thank you.
Greg, thanks very much. And we don't really have time, as Greg said, we don't have time for more questions right now. But if you do have questions, please email us, and we will be sending an email out tomorrow, including the replay link to this presentation, as well as information on how to purchase the slides if you're interested. And again, as Greg said, we'll make sure that the slides have all the content on them. There's something with the webinar software that affected the slides that were received. And also more information on our national conferences coming up in September. So we hope to see you all there and to see you on upcoming webinars. Thanks very much for joining us today.